All right, thank you very much. Now it's my role to talk about social mood, stock market performance, and incumbency. Incumbents have certainly had a rough go of it lately here in the UK. Gordon Brown out, David Cameron and the coalition in, and now they're having problems of their own. And incumbents have been ousted or resigned in many countries over the past few years. Sarkozy out in France, Berlusconi out in Italy, Spain, Ireland, Greece, Portugal, the Netherlands, Finland, Denmark. Things are a little bit less clear in Latvia. There's a new president but the same prime minister. But it hasn't been entirely bad news. Incumbents have been retained in a few places, Russia, Poland, Estonia, and in Sweden. Discussion of this anti-incumbent sentiment is often discussed in terms of austerity, the politics surrounding the economy and spending cuts, financial crisis, these sorts of things. And I thought to provide a richness or perhaps even a slightly different perspective on these very issues, would tell you a little bit about some research that my colleagues Robert Prechter, Deepak Goel, Wayne Parker, and I have done when we investigated the historical relationship between stock market performance and the entire case history of U.S. presidential elections. And we framed our study from the standpoint of socionomic theory, and if you had to boil it down and put on a bumper sticker what exactly socionomic theory is, you can summarize it, as Prechter did in 1999, as saying that social mood influences the character of social actions. If you think about social mood, or at least one manifestation of it being people's general feelings of optimism or pessimism about the future, you can think about the stock market as one place where that may become manifest. People become more optimistic, they bid up stock prices, and do the opposite when mood becomes increasingly pessimistic. But they can also express that mood in a number of different places, including in the voting booth. So this led us to three hypotheses which stem from a larger general hypothesis, which is that social mood should influence or be associated with the outcomes of presidential re-elections. But more specifically, we generated three hypotheses here, and that is that there should be a significant positive association between the net change in the stock market and the subsequent outcomes of incumbents in their re-election bids. Furthermore, the stock market, as a rather immediate indicator of social mood, people can express their optimism and pessimism in the market fairly quickly. It just takes a few moments to trade a stock. So the stock market should have greater explanatory power than economic variables like GDP, inflation, and unemployment, at least historically. Now, these macroeconomic variables may be salient political issues and discussion points in particular elections, but as far as historical explanatory power goes, we expected to see the stock market as the greater predictor. Social mood may influence these other variables, but if you think about the type of actions that people take to express their mood in terms of impacting something like economic growth, you're looking at things like expanding businesses, ramping up productivity. Those things take time to affect, certainly longer than it takes to trade a stock. And furthermore, since we think that the underlying issue, an important component at least, the underlying issue here is social mood, that the portfolio effect, in other words, people's responses to their gains and losses in the market, should be insufficient to account for these results. And we'll look at the results in a moment, but just a brief disclaimer about what this study is not. We are not interested in forecasting the outcomes of specific elections, nor are we interested in creating a finely tuned and highly parameterized retrodiction model that accounts for every wiggle and vote margin historically. What we're interested in doing is examining the historical explanatory power of the stock market in relationship to re-election outcomes and comparing that explanatory power to that of other variables, just looking at the raw rate of change. All right. So the main way that we investigated this question was to look at the relationship between the net percentage change in the stock market in the 3 years preceding a president's re-election bid and the incumbent's popular vote margin, the number of percentage points that separate the incumbent from his nearest challenger in the popular vote. But we wanted to make sure that we were looking at real results here, so we did perform a number of variations in the testing procedure itself. We varied the dependent variable, we varied the independent variable, and we also looked at different study periods. We went all the way back to 1792 in the electoral vote. and we went all the way back to 1824, that's when we start to get really good national level popular vote data. But just to make sure that our results weren't due to some sort of old historical relationship that may not hold more recently, we bifurcated the data at some important points, and I'll talk a little bit more about that in a bit. So as you can see, there's a number of tests in the paper, a number of results, and if you'd like to read about all of them, I would refer you to the paper itself. It's available on this conference's website in the paper list. It's also on the Social Science Research Network, so you can download it there. But today we're going to focus on the main result, on the main result, and that's the relationship between the 3-year rate of change in the stock market and the incumbent president's ensuing popular vote margin. And you might ask, why 3 years? Well, we observed anecdotally that presidents, their predecessor, tended to get the credit or blame for things in the first year of their term. So since they served 4-year terms, we thought the 3-year window might have some particularly good explanatory power. So the main result is on line 3 of the table here. This is, again, the popular vote data, so we go back to 1824. And we see that the just using the raw net percentage change in the stock market in the 3 years preceding the election, using that one variable alone, we can account for about a third, a little bit less than a third of the variation in the incumbent's popular vote margin. You see the R-squared value, they're just under a third. And these results are robust to the variations that I described. We put a few of them on the slide here just to give you a feel for the types of variation that we saw. But from here on out, we'll focus on that 3-year result. So that was our first research question. Is there a positive association between the trend in the stock market and the ensuing popular vote margin? And that seems to be the case historically. So now we move on to the second research question. That is the explanatory power of the stock market greater than some other macroeconomic variables? So we'll look at those results here. And this is the same analysis going back to 1824, looking at the 3-year change in the stock market versus the 3-year change in real GDP, nominal GDP, inflation, and unemployment. Now, a caveat about the unemployment data, we only have good national level unemployment data going back to 1940. So if anyone knows of a better national level unemployment data series that goes back farther historically, I'd love to hear about it. But what we found when we looked at the history of the data was that the stock market's explanatory power was greater than each of these variables. Explained a little bit less than a third. GDP explained a little bit less than a quarter. Real GDP, nominal GDP, a little bit more than 10%. And inflation and unemployment are hovering around the 0 point. Results for real GDP and nominal GDP were still significant statistically in simple linear regression, so we wanted to do some multiple regression analyses to see if the stock market could account for maybe one dimension of the vote decision, but maybe GDP was accounting for some different dimension, and if we combine them together, we might see more robust results. Again, looking at all the data historically. Now, there's a lot of text on this slide, but I can sum it up very simply, and that was when we performed a variety of multiple regression analyses, the predictive power of real GDP and nominal GDP disappeared in the presence of the stock market. And all of the combinations that we performed, the stock market remained a significant predictor, whereas the explanatory power of these other variables disappeared, and the findings held up even after correcting for multiple comparisons. So that was the second research question. Is there more explanatory power in the stock market than in these other variables? We thought that there would be, because we thought it would be a more immediate indicator of mood. All right. So what about the third research question, the portfolio effect? Is it the case that people are just making money in the market and attributing some of that goodwill to the incumbent and placing their vote accordingly? Well, if that's true, then the market should be a relatively poor predictor in periods where the very small percentage of the population owns stock, and should be a better predictor when there's greater stock ownership. So we bifurcated the data in 1900. Now, the percentage of American households that owned stock in the 1800s essentially rounds to 0. Very few people own stock. And if you want to take a more sociotropic view, maybe people are just more aware of the market because it's reported every day just about in the press. In the 1800s, most Americans lived in rural environments. We didn't, of course, have television and radio. Even the local newspapers rarely would report stock market averages unless you lived in a major metropolitan area. So by cutting the data here, we could see if, in fact, the stock market had more explanatory power in more recent years than in later years. And in fact, if you look at the R-squared values, what you find is that, well, actually, the market's a significant predictor in both time periods, but It's actually a slightly better predictor in the 1800s when hardly anybody owned stock. So the portfolio effect doesn't seem to really account for the findings. And we also did a similar test bifurcating the data in 1950 to look at an even more recent difference in stock ownership and stock reporting. And the results are qualitatively very similar. So the portfolio effect doesn't seem to account for the findings. So now if we look back at this list of ousted incumbents and retained incumbents, colleague Alan Hall put this list and this analysis together. What he found was that if you look at the rate of change in the stock market, in the incumbents term, barring the first year, remember we thought that the predecessor tended to get the credit for that year, and the places where the incumbents have been ousted, they tended to have a decline in the market, and in the places where the incumbents have been retained, those markets tended to have a positive trend. The exception is Sweden, but like we said, the majority party there lost the strong majority. Now, I'm not implying that the results and findings from America are easily generalizable to these cases. I'm not making that point. And this next table bears that out a little bit. This is looking at U.S. data still, but this is the relationship between the 3-year change in the stock market and the incumbent party's popular vote margin in elections where there was not an incumbent president. So elections where the incumbent president was term limited or chose not to seek another term, when the incumbent himself wasn't seeking re-election. If you just look at the incumbent's party, what you find is that the explanatory power of the market drops to essentially zero. There's very little explanatory power at all in those cases, and it goes back to the idea, at least from our point of view, one way to think about it is that people are projecting their moods, rather consciously or unconsciously, more likely, on people rather than parties generally. But in times where mood is particularly ebullient or particularly depressed, then the trend of the market might become a more salient indicator of which way the incumbent's fate will go. So we'll just look at a kind of extreme manifestation of that. This is a chart of a stock index. Would anyone like to guess where? Oh, no takers. That's too bad. This is the NASDAQ index of Middle East and North African stocks. And there was an enormous crash in the market. The stock values fell 62% over the course of months. They rallied briefly, stagnated, and then resumed a downward trend. And the Arab Spring took place in the latter part of that movement. The street vendors' self-immolation was there, and then the incumbents in Tunisia, Yemen, Libya, and Egypt got thrown out of office as that downward trend resumed. And just for clarity, again, we're not arguing that the revolutionaries all were heavily invested in exchange-traded funds, and they got their account statements and just couldn't believe the loss and took to the streets. Rather, what we're saying is that these markets are indicators of something else psychologically, and some people express that by bidding down share prices, and other people express it in different ways. All right, that's my time. That's probably a contentious point enough to end on, so thank you for your attention.
Thanks very much.